Welcome to this Killick Explains video, and welcome to a new take on a slightly old topic. Now, first of all, the old topic is the well-documented fact that over time, professional or institutional investors, as they're known, tend to outperform private or retail investors in the equity market. Now, that's a reasonably well-established fact, but why? And here comes the new angle. And I'm going to use some research from 2019 by three professors, Lowe, Remerov and Chouch, to make the point. And their basic conclusions are, number one, individual private investors tend to oversuffer from recency bias. Although the past is no guide to the future, as regulators are keen to point out, nonetheless, individual investors tend to rely on the past too much. They anchor to the past, if you like. Meanwhile, institutions might, in all other circumstances, also be anchored to the past, might also suffer recency bias, but they're forced not to. Because institutions have to do a thing called quarterly rebalancing, they have to make sure they're following their mandates, they're sticking to their strategy long term. That forces them every now and again to sort of skim off holdings that have got overweight, as they like to call it, too big in normal parlance, and build up holdings that have got a little bit small, and underweight, as they like to call it. And that activity, which basically forces them to stay on mandate, is responsible for giving them almost a contrarian angle to investing, which makes them automatically more successful. So it's like an unfair inbuilt advantage, you might say, penalising individual investors who are tempted to let the past guide what they do today for tomorrow too much. Now, what about some evidence? Well, what the paper is suggesting is that actually individual retail investors tend to, unfortunately, buy high as a result of allowing the past to dictate their actions and sell low, whereas rebalancing means institutions sort of automatically do the reverse. They're sort of forced to take a contrarian position, so they're buying the stuff nobody else wants in theory and selling it when it's more expensive. And the evidence for this, well, they present a lot of evidence, but they looked at S&P 500 declines of 10 to 20% and looked at what happened to equity allocations. And they found that they drop for 44% of individuals, but only 17% of institutions. And meanwhile, they rise for 17% of individuals, 67% of institutions, and 52%, while we're on the topic, of advisors. So you can see the contrarianism, if you like, coming in to the institutional view of equity markets versus the individual view. Now the question then becomes, how do you stop yourself being that individual investor that makes the wrong response and doesn't get the benefit of almost the forced response that institutions follow through a more systematic approach to investing? Well, number one is to know what kind of investor you are. And this requires a bit of honesty. And there are 5 types, according to this paper. This is actually quite interesting in its own right, because as I read these out, you might think to yourself, which one of these am I? And you can afford to be honest, because I'm not there to challenge you, if you like. So number one, are you an extrapolator? And of course, this paper indicates how many people on average tend to be each type. Extrapolators follow the market up and down. And more people are that, especially at the individual retail investor level, than might realise it. And that is potentially a problem, because by following the market, you're going to tend to buy high and then sell low, if you like. You're buying after everybody else, selling after everybody else. Now, the second type is passive investors out of 5. Passive investors tend to leave their allocation alone no matter what the market does. And that is better than being an extrapolator in many ways. Then you've got risk avoiders. And what risk avoiders do, and think to yourself, am I actually this person, hand on heart? What they'll do is they'll reduce their exposure when the market is volatile in either direction. They get nervous when the market starts to move around off trend, even if it's moving to their advantage in theory, if you like. Contrarians. Now I mentioned these before. Contrarians will buy a falling market and sell a rising one. As Warren Buffett once put it, they're the people who are greedy when other people are fearful, and fearful when other people are greedy. But that, according to this paper, is only 8% of individual investors. So if you're thinking, yes, I'm a contrarian. I'm afraid the statistics suggest you're probably not, or not to the degree that you think you are. And then there are optimists. An optimist will tend to buy the market regardless. They have a strategy, they might drip money in on a monthly basis for argument's sake, and they'll do it. They won't turn off the direct debit no matter what the market does. And that drip feeding approach has been demonstrated to be quite beneficial in volatile markets in particular. So here are a few closing thoughts for you. Number one, try and decide which of those 5 types you are and try and move yourself out of the extrapolator box, if you like, and out of the risk avoider box in particular. Number two, stick to your guns. So institutions are forced to stick to a long-term strategy, and rebalancing actually gives them a kind of an edge over individual investors. And then number three, I've got 2 or 3 takeaways just to consider. So something which really hammers the returns of individual investors compared to institutions is panic selling. And at the moment we're in an environment where when the market dips, some people have been getting these regular 10% letters, for example. It worries people, it makes them nervous. They think, should I bail out? Now, some closing thoughts. First of all, if you're thinking I'm not the kind of person that panic sells because I'm an experienced investor, well, actually, the same paper I referenced earlier suggests that it is experienced investors who are more prone than novices to bail out of the market. Now, the reasons for that could be varied. Perhaps they think they've got more to lose. Perhaps they're older on average and are worried about, moving on to life after work and losing money that way, market timing. But that's something to think about. Experienced investors more likely to panic than less experienced. So there's a slightly surprising finding. Number two, men are more likely to panic than women. Women tend to engage with investing, it's fair to say, the statistics are out there to back it up, less than men, but when they do, they are pretty good at it, as it turns out. If you like, a degree of passivity, a degree of not watching their screens too often tends to play to their advantage. So there we have it. Lots of information there and some jargon thrown in en route. So if you'd like to know more, killick.com/learn gets you to our extensive library. And don't forget, we've got our 6 guides as well, authored by me. That would be editor@killick.com. And the same address if you've not read Confidant just behind those guides and would like a copy.